Every country issues money, but only a few currencies travel the planet. Japan spends in yen, Europe in euros, Britain in pounds. Yet global trade often settles in US dollars. Why do containers, contracts, and central banks orbit a currency printed in one nation? Because dollars clear fast, scale globally, and are trusted when pressure rises. Most of these dollars never touch US soil. They move offshore, across banks, ports, and payment rails, greasing everyday commerce. If the world stopped using them, trades would slow, risks would spike, and finance would rewire itself. Gradually, not overnight. Welcome to Wallet Economics. In this film, we unpack reserves, trust, and how the dollar earned its role, and what change would really look like. Foreign exchange reserves are a country's financial shock absorbers, foreign cash and safe securities held by central banks. They pay import bills in a crunch, steady exchange rates, and signal credibility to investors. Gold appears too, nobody's IOU, durable across decades. Though daily operations rely more on interest-bearing securities that can be sold quickly for cash. Typical reserves: US dollars, euros, yen, pounds, and short-term government bonds that convert to cash quickly, plus smaller holdings of gold and IMF assets. Picture trade routes pulsing across a world map. When prices jump or currencies wobble, officials draw on reserves to keep fuel, food, and medicine flowing and to defend the exchange rate. Banks hold dollar liquidity because contracts for energy, machinery, and food often price in USD. Speed and certainty let payments clear in minutes across borders. Analysts track adequacy with simple rules of thumb: months of import cover and coverage of short-term external debt. Practical gauges of resilience. After World War II, Bretton Woods linked major currencies to the US dollar and the dollar to gold. The United States combined vast industry, deep capital markets, and a growing supply of treasury securities, natural anchors for rebuilding trade. In 1971, the gold link ended, but the system did not. Contracts were enforceable, markets remained liquid, and the Federal Reserve prioritized price stability over time. Investors could park savings in treasuries, banks could move dollars quickly, and companies could quote prices in a currency everyone recognized. Depth mattered. Dollar money markets absorbed huge orders with small price moves. Euro-dollar networks spread dollar funding across borders. Trust compounded. Settlement, auditing standards, and predictable rules reduced friction. Advantages gold alone could not provide. Network effects did the rest, keeping dollars at the center. Governments hold dollar assets because they clear fast and reliably, vital when headlines turn volatile. In a sell-off, treasuries can be sold within minutes to raise cash with modest price impact. Intervention is straightforward. A central bank sells dollars to buy its own currency, slowing a slide and buying time for policy moves. Inside the vault, risk limits matter. Reserves are diversified, maturities laddered, and collateral kept repo eligible for next-day liquidity. During global shocks, swap lines and money markets transmit dollars abroad, helping firms refinance, settle insurance claims, and keep trade moving. Officials balance safety, liquidity, and return, diversifying at the margin into euros, yen, and gold, while a large core stays in dollars for scale and convenience. Across borders, many contracts price in dollars, reducing currency risk and making invoices predictable for both sides. Suppliers and buyers often settle in USD because payment rails are fast and widely accessible. Dollar clearing networks offer liquidity at scale, so funds arrive on time and disputes shrink. Global loans and bonds frequently issue in dollars, tapping deep investor demand and transparent benchmarks. The more people use dollars, the more useful they become. Classic network effects that reinforce habit and convenience, including in energy trade. In the 1970s, major oil exporters priced crude in dollars, channeling steady global demand for USD. Because energy is widely traded in dollars, nations and companies keep dollar balances to buy fuel and hedge price swings. Important caveat: oil reinforced the dollar's role. It did not create it. The foundations were already there: market depth, legal certainty, and global scale. Dollar dominance rests on many pillars: the size of the U.S. economy, liquid capital markets, political stability, and extensive trade networks. The euro is the closest peer, backed by a large economy and credible institutions, but fragmented capital markets and varied fiscal frameworks limit global reach. China's renminbi is playing a larger role in global trade and international finance. However, capital controls, less open financial markets, and concerns about legal and institutional transparency continue to limit its role as a major global reserve currency. Gold offers permanence without credit risk, but it pays no interest, is costly to move, and is impractical for daily settlement. Digital currencies and new payment rails are promising technologies, but reserve status requires liquid safe assets, rule of law, and a lender of last resort. Bitcoin attracts attention as a digital asset. However, it is not a major reserve holding for central banks today. If countries trim dollar reserves, they diversify into euros, yen, gold, and some renminbi. Liquidity would spread, and costs could rise during stress. Borrowing might become pricier in thinner markets as investors demand higher yields for similar risk. Payment systems would adapt, but transitions are rarely smooth. With diversified reserves, bid-ask spreads can widen in turmoil, and some trades take longer to clear. Firms would juggle more collateral types and hedge more currency pairs, expenses that filter into prices for households and governments. Transitions usually layer, not break. Regional finance deepens in local currencies while global players still settle in dollars for speed and depth. Over years, portfolios could tilt toward other assets, yet benchmark roles persist when legal certainty, deep markets, and lender of last resort access dominate. Most shifts are gradual, setting up the conclusion. Almost 180 currencies circulate worldwide, each serving a home economy. Only one, through scale, depth, and trust, became the backbone of modern global finance. That is why governments and businesses still hold trillions of US dollars, because payments must clear, even on the hardest day. Thanks for watching Wallet Economics. Subscribe to go deeper into the systems behind everyday money.